Okay, let's dive right in. We're sitting here at the start of 2026, and the financial world is at a fascinating, really historic crossroads. We're seeing a massive disconnect between the value of financial assets and the value of the raw materials that literally build our world, a divergence we just haven't seen in decades. This is the story of that great imbalance.
So what's this all about? Well, at its core, it's a classic tug-of-war. On one side, you've got the S&P 500. This is the world of paper assets, right? It's a claim on what companies might earn in the future. And on the other side, you have commodities, the world of physical assets, the actual tangible stuff like copper and aluminum that makes our economy run today. And that brings us to the big question we're tackling in this explainer. What happens when the value of that paper massively outweighs the value of the physical stuff? I can tell you one thing, history shows us these kinds of imbalances don't last forever. So let's dig in. All right, so here's how we're going to break it all down. First, we'll look at the incredible gravity-defying rise of the stock market. Then, we'll shift gears to the real economy's building blocks. We'll introduce a really key ratio that lays this imbalance bare, explore why 2026 is looking like a major tipping point, and then wrap up with what this all means for how you might think about your own portfolio.
First up, let's talk about the heavyweight champion of the financial world, the S&P 500. I mean, it has been on an absolutely epic run, one of the longest and most impressive in modern history, really supercharged by tech and more recently, the AI revolution.
And when you look at the long-term numbers, it's pretty incredible. You can see over a century and a half a super reliable 9% return. But here's where it gets really interesting. Look at the last 5 years. That number just explodes to 16% a year. That's not just growth, people. That's acceleration on a massive scale. And it really makes you ask, is that sustainable? So that brings us to our snapshot in January 2026. The S&P 500 is trading right around 6,950. Now, by itself, that's just a number. But what it really represents is a huge amount of optimism about the future. The real question is it maybe too much optimism?
Well, get ready for this. That level, 6,950, is a whopping 82% above its long-term historical trend line. Let me just say that again, because this is a big number. 82%. What that suggests is the market is pricing in absolute perfection for years and years to come.
So what does that mean in plain English? Well, statistically, this is what you'd call a 2.3 standard deviation event. Basically, it's a total outlier, a statistical extreme. And whenever we see valuations get this stretched, well, history tells us a major correction, or at least a long period of going nowhere, might be just around the corner.
Okay, so we've talked about paper. Now let's flip the coin and talk about the real physical stuff, the industrial commodities you can actually hold in your hand.
See, like a stock, which is really just a promise of future profits, a commodity's value is all about the here and now. It's driven by that real-time tug-of-war between the physical supply coming out of the ground and the physical demand from factories building things. They are the essential ingredients of our economy. And here's why this stuff is so interesting for a portfolio. First off, commodities often zig when the stock market zags, which is exactly what you want for diversification. They're also a fantastic hedge against inflation. When the cost of everything is going up, raw materials are usually leading that charge. Sure, they can be more volatile, but they have this fascinating knack for doing really well late in an economic cycle, just when stocks start to get tired.
So we have these two completely different worlds, right? Stocks and stuff. How on earth do we measure the relationship between them? Well, it turns out there's one simple but incredibly powerful ratio that cuts through all the noise and pretty much explains everything.
We're going to use the S&P 500 to Producer Price Index ratio. Now, don't let the name scare you. The PPI is just a broad measure of the price of physical goods. So this ratio simply compares the price of the stock market to the price of stuff. Super simple, right? When the ratio is high, stocks are really pricey compared to commodities. When it's low, commodities are the expensive ones.
And the really wild thing is, when you look back through history, you see this incredible pattern. It moves in these long, kind of predictable 18-year cycles, where one is in charge and then the other takes over. You see commodity dominance in the inflationary 70s, then stock dominance in the 80s and 90s. And since 2011, it's been all about stocks, fueled by that AI boom.
So the billion-dollar question, where are we right now? Well, take a look at this chart. It says it all. The historical average for this ratio is about 12.5. Today, in January 2026, it's sitting at 26.6. We are more than double the historical average.
This, right here, is the great imbalance visualized in a single picture.
You know, an imbalance this huge just can't last forever. Something's got to give, and it looks like 2026 is shaping up to be the year where we see a perfect storm of catalysts all pushing for a massive change.
Let's just run through them. The AI revolution, it's not just code. It's a massive physical build-out requiring tons of copper and aluminum. The green energy transition, you need an unbelievable amount of metal for that. Then you have rising geopolitical tensions forcing countries to stockpile resources. And top it all off with the Fed starting to cut interest rates, which usually weakens the dollar and makes commodities cheaper for the rest of the world, boosting demand. It's a powerful combination.
And hey, this isn't just some abstract theory. You can see it happening in the prices right now. I mean, look at this. Copper, which they call Dr. Copper because it's so good at predicting the economy, is up 40%. Tin, which is crucial for all our electronics, also up 40%. And silver, it's gone absolutely parabolic, surging an incredible 155%.
But here's what's really telling. It's not like everything is going up. Iron ore is actually down, mainly because of China's property mess. This shows us it's not just a random commodity boom. It's a very specific structural rotation, a shift away from old-world building materials and towards the specific metals needed to power our high-tech future.
Okay, so let's bring this all home. We have this massive historical imbalance. We have all these powerful forces pushing for a change. What does this actually mean for you, the average investor? Well, it might mean it's time to rethink the standard playbook.
You know, the legendary investor Ray Dalio said it best. Diversification is the holy grail of investing. And wow, has that ever been more true than it is right now, in an environment where these fundamental relationships are shifting right under our feet.
For years and years, the classic 60-40 portfolio, 60% stocks, 40% bonds, was the gold standard. But maybe, just maybe, in this new era, it's time for an update. Time to think about carving out a dedicated slice, maybe 10, maybe 25%, for real assets. You know, the physical stuff. It could be a crucial way to protect your portfolio and even capture some of the upside from this great rebalancing. And that leaves us with one last big idea to chew on. For the past decade, it's been all about digital abundance, unlimited information, endless lines of code. But as we build out that amazing digital future, we're running smack into the hard reality of physical scarcity. So the real question is, moving forward, which one holds the ultimate value?